Market Psychology. You're not losing to markets. Episode 1. The Problem. Checking your portfolio is the most expensive habit you have. How much has that cost you? Not in time. In money. Real money. The kind that compounds over decades when you leave it alone, or evaporates in months when you don't. Most investors think their biggest risk is picking the wrong stock or timing the crash poorly. They're wrong. The biggest risk is you. Your reflexes. Your need to do something when the screen turns red. Your inability to sit still when everyone around you is moving. Marcus Aurelius wrote in his private journal, "You have power over your mind, not outside events. Realize this, and you will find strength." He was talking about leading an empire, making decisions that determined the fate of millions. But he understood something that applies directly to your portfolio. The moment you accept that the market is outside your control, you stop bleeding money to your own reactions. Today, the S&P dropped 0.63%. The Nasdaq fell 1%. These aren't crashes. These aren't even tremors. The VIX, the market's fear gauge, sits at 15.79. That's calm. That's normal. That's the market breathing. And yet, 80% of investors checking their accounts today felt something. Unease. Doubt. The urge to adjust. To protect. To act. That feeling, that compulsion in a calm market is the problem. Because if you can't sit still when nothing is happening, you have no chance when something actually does. The market isn't your opponent. Your psychology is. And until you recognize that, every uptick and downtick will cost you more than the market movement itself. The losses aren't coming from market violence. They're coming from the space between the red number appearing on your screen and your finger hovering over the sell button. That's where fortunes disappear. Not in crashes. In calm Tuesday afternoons when you just couldn't leave it alone. Let me show you what this looks like in real time. Marcus Stone sat across from Alex Rivera in a coffee shop 3 blocks from the exchange. It was early March 2008. Not the bottom. Not even close. But bad enough. The S&P had dropped 2.1% that day. Banks were showing cracks. Bear Stearns rumors were everywhere. Alex's phone was face up on the table. Marcus noticed. He always noticed. Alex had been checking his portfolio every hour for 3 weeks. Sometimes every 30 minutes. He'd refreshed it twice since they sat down. His tech-heavy portfolio, the one he'd built so carefully over 4 years, was down 18% from its high. Not catastrophic yet, but bleeding. And every time he looked, the number was worse. He'd already sold 2 positions the week before, taking losses he told himself were strategic. Preservation, he called it. Marcus called it something else. "What are you protecting yourself from?" Marcus asked, gesturing at the phone. "From losing more than I already have," Alex said. His jaw was tight. He meant it. Marcus leaned back, and for a moment he just watched Alex. Then he said something Alex didn't expect. "You think the market is doing this to you? It's not. You're doing it to yourself. The market doesn't know you exist. It doesn't care about your cost basis or your retirement date or how hard you worked for that money. The only person in this equation who's making decisions based on fear is you." Alex bristled. "So I'm just supposed to sit there and watch it drop?" "No," Marcus said. "You're supposed to decide, once, what kind of investor you are. Then you stop deciding. You already decided when you bought those shares what you believed about those companies. You decided they were worth owning for the long term. The only thing that's changed is the price. And the price is just noise until you make it real by selling." The next day, the S&P dropped another 1.2%. Alex didn't check until market close. It was harder than he expected. The urge was physical. His hand reached for his phone 4 times in the first hour. Each time, he stopped. He remembered what Marcus had said. The market doesn't know you exist. By the end of the week, he'd gone entire afternoons without looking, not because the market improved. It didn't, but because he started to see the pattern. Every time he checked, his conviction weakened. Every refresh was a small erosion, not of his portfolio, of his philosophy. 6 months later, the real crash came. Lehman collapsed. The S&P would eventually drop 57% from its peak. But Alex didn't sell. Not in September. Not in October. Not in March of 2009, when it felt like the world was ending. Because he'd already fought the hard battle. Not against the market. Against himself. Against the compulsion to react. He'd learned that the cost of looking wasn't information. It was conviction. Every glance at a red number was a referendum on whether he still believed what he believed yesterday. And referendums, held hourly, always end the same way. You capitulate. By 2010, his portfolio had recovered. By 2012, it had doubled his original cost basis. But the real return wasn't the money. It was the 8 years after that. 8 years where he never once panic sold during a correction. Because he'd learned the lesson when the stakes were highest. You don't lose to markets. You lose to the part of you that can't stop watching them. Stay with this decision for a second. It's the one that separates reactive investors from stoic ones. The decision isn't what to buy or when to sell. It's whether you're going to treat your portfolio like a dashboard that requires constant monitoring or a garden that requires patient neglect. Most investors think their edge is information speed, awareness. Marcus Aurelius knew better. Your edge is your ability to not react, to see the information and do nothing, to let the people around you trade on fear while you trade on principle. That's not passive. That's the hardest active decision you'll ever make. Here's what you do next. The next time the market drops any amount and you feel the pull to open your app, your browser, your account, stop. Don't check, not for 24 hours, just one day. You're not ignoring the market. You're testing whether you're an investor or a spectator. Investors decide in advance. Spectators react in real time. If you can't go 24 hours without checking, you don't have an investment strategy. You have an anxiety disorder with a brokerage account. If this shifted how you see your own instincts, subscribe. Next time we'll show you what to do with that awareness. Most investors already know this is happening. Do you?